This is problem 12.6 from Brigham and Houston's Fundamentals of Financial Management, Concise 9th edition. And here we're drawing a distinction between two depreciation methods, the straight line depreciation method and the MACRS depreciation. MACRS stands for Modified Accelerated Cost Recovery System. And generally it's faster depreciation so that companies can get their tax refunds faster, and companies typically use that for tax reporting purposes, although they might use other depreciation methods for their normal financial reporting. So companies can keep two sets of books, one for tax purposes and one for financial reporting purposes. All right. Now, the advantage of MACRS is that it depreciates things faster, which means that you'll get the same tax deduction, you'll just get it sooner rather than later. Now let's demonstrate that. We'll go with the years 1, 2, 3, and 4. And we're going to be depreciating $800,000 for either method. Now, for the straight line, the problem says ignore half-year conventions and all that other crap. Just take it over 4 years, so that'd be 25% a year. And I'm not going to show pennies. All right, so you'd get $200,000 depreciation over the 4-year period. Using MACRS, the 3-year MACRS, which actually goes over 4 years, would be 33% the first year, 45% the second year, 15% the third year, and 7% the final year. All right, so you can see that the depreciation expenses are front-end loaded with MACRS, and then the latter years, they're actually lower. So the impact of this would be the tax savings. All right, when you report the $200,000 of depreciation as an expense, it means it reduces your taxable income, which will reduce your taxes. The company is on the company has a 35% marginal tax rate, so that'd be 35% of the straight line depreciation each year would mean that it would reduce your income taxes by $70,000 a year. With the MACRS, it'll reduce your taxes much more in the first 2 years and less so in the last 2 years, which would produce a higher NPV at a weighted average cost of capital of 10%. That grand total of $280,000 of tax savings comes out to a present value of $231,849. The difference is with MACRS, because you get more money sooner and you could go spend it on profitable assets sooner, there's a $9,479 difference in the present value of the tax savings. So the MACRS would be the better method, and it's the one that we typically assume is going to be used. It doesn't make your machine depreciate any faster, it just means you can claim the tax deduction faster, and that's the whole purpose behind when they invented MACRS back in the late 1980s. So the answer is the depreciation expense each year That's Part A. 200,000 a year under straight line, and then it's 264, 360, 120, 56 under MACRS. Part B, the net present value of the tax savings is much higher for the MACRS, higher by about $9,500.